Warren Buffett has access to every stock on the market, every data point, every management team, every opportunity most investors only read about. Yet year after year, he ignores almost all of them. That isn't because he lacks options, it's because restraint is the strategy. While most investors believe success comes from finding the next great stock, Buffett has built his record by doing the opposite, by saying no far more often than yes. This tension between unlimited access and deliberate avoidance is where his real advantage lives. Long-term investing, in Buffett's world, isn't about activity, it's about selectivity. And honestly, understanding why he avoids most stocks reveals far more than studying the few he actually buys. Most investors start with a ticker symbol. Buffett starts with a business. To him, a stock is just a small, moving label attached to a real operating company underneath. What matters isn't the price chart, but how that business actually makes money, how it generates cash, serves customers, and survives competition. Buffett has often said he imagines buying the entire company, not a piece of paper that trades every second. That simple shift in perspective eliminates most of the market instantly. Many public companies exist, but only a fraction operate in a way that produces consistent, understandable cash flows over long periods. When you stop thinking like a trader and start thinking like an owner, the universe of investable stocks shrinks dramatically. But even great businesses don't automatically qualify. Buffett doesn't believe investing is about being the smartest person in the room. He believes it's about staying within what he truly understands. That boundary, what he calls the circle of competence, is far smaller than most investors admit. Entire industries can be profitable, exciting, and widely discussed, yet still fall outside that circle. When Buffett doesn't understand how a company really makes money, what drives its costs, or why customers stay loyal, he doesn't analyze further. He moves on. Too hard isn't a weakness in his framework, it's a strength. By refusing to venture into businesses he can't clearly explain, he avoids mistakes that intelligence alone can't fix. And this filter becomes even stricter when time enters the equation. Buffett doesn't invest based on what a business looks like today. He invests based on whether he can reasonably imagine it 10 years from now. If the future of an industry depends on constant reinvention, shifting technology, or unpredictable consumer behavior, he steps aside. Rapid change may create short-term winners, but it also creates long-term uncertainty. And uncertainty is something Buffett avoids. He has often explained that he wants businesses whose economics are likely to remain familiar over time. Not exciting. Familiar. Stability matters more to him than fast growth, because stable businesses allow compounding to work quietly and consistently. Many companies fail this test, not because they're bad, but because their future is just too unclear. And that's why predictability alone still isn't enough. A business can be predictable and still be vulnerable. That's why Buffett looks for something deeper, a durable competitive advantage. Without it, strong profits attract competitors, and those profits slowly disappear. Buffett often compares this advantage to a moat protecting a castle. The wider and more difficult it is to cross, the safer the business inside. But true moats are rare, and many that appear strong don't last as long as investors expect. Popular companies often thrive because of trends, pricing power that can be challenged, or advantages that competitors can copy. Buffett avoids these situations entirely. If a business can't defend its position year after year without constant effort, it doesn't qualify. And even with a moat, Buffett still walks away from most stocks. Even the best business can become a poor investment at the wrong price. Buffett has repeated this idea for decades, often reminding investors that paying too much leaves no margin for error. A wonderful company doesn't guarantee wonderful returns if expectations are already built into the price. This discipline alone explains why Buffett avoids most stocks during bull markets, when optimism pushes valuations beyond what long-term economics can justify. While others feel pressured to act, Buffett is comfortable waiting. Patience, in his approach, isn't passive. It's an active decision to protect future returns by refusing to overpay today. Most opportunities disappear not because the business changes, but because the price stops making sense. And this patience creates another common misunderstanding. For Buffett, doing nothing is often the correct move. He has said that inactivity can be the hardest discipline in investing, yet it's also one of the most powerful. Most stocks don't meet his standards at any given time, and that doesn't bother him. He doesn't feel the need to be constantly invested just to feel productive. Holding cash isn't a sign of indecision in his framework. It's a strategic position that preserves flexibility. Cash gives him the ability to act decisively when rare opportunities appear, without pressure or regret. While many investors equate action with progress, Buffett understands that restraint is part of the process. But the hardest part isn't waiting, it's resisting emotion. Buffett understands that the greatest investing mistakes aren't analytical, they're emotional. Stocks that create urgency, excitement, or fear tend to push investors into decisions they later regret. That's why Buffett avoids situations that make him feel rushed or pressured to act. He has often noted that investing should feel almost dull when done correctly. The best opportunities don't demand immediate action or spark adrenaline. They quietly make sense. By filtering out anything that triggers emotional reactions, Buffett automatically eliminates a huge portion of the market. This psychological discipline protects him from following crowds, chasing trends, or reacting to headlines. It's not about suppressing emotion, but designing a process that doesn't depend on it. And honestly, this discipline explains a common misconception. Emotion is the real enemy. The best ideas feel boring. So many people assume Buffett avoids most stocks because he's conservative. In reality, he's focused on a very specific kind of risk, the risk of permanent capital loss. Short-term price swings don't concern him if the underlying business remains strong. What he avoids are situations he doesn't fully understand or can't reasonably predict. In Buffett's view, volatility is not risk. Misunderstanding is. By saying no to most opportunities, he concentrates his capital only where his conviction is highest. Fewer bets allow deeper understanding, closer monitoring, and greater confidence over long periods of time. This approach may look cautious on the surface, but it's actually a disciplined form of risk management, which leads to the final, counterintuitive takeaway. Risk is misunderstanding. Fewer bets, higher conviction. When you study Buffett's career, a clear pattern emerges. His greatest results didn't come from hundreds of clever decisions, but from a small number of exceptional ones. Extreme selectivity is the common thread. Buffett has often explained that investing doesn't require constant brilliance, it requires avoiding serious mistakes. By saying no to almost everything, he preserves capital, attention, and patience for the rare opportunities that truly matter. In his framework, missing a good idea is far less damaging than committing to a bad one. Over decades, this asymmetry compounds. A handful of well-chosen decisions can shape an entire lifetime of returns, while a few major errors can undo years of progress. This perspective sets the stage for a deeper reflection on long-term thinking. Success comes from saying no. Warren Buffett's success isn't built on constant action, but on deliberate avoidance. What looks like restraint on the surface is actually a refined form of wisdom, knowing what to ignore and why. In a market full of noise, predictions, and urgency, long-term investing rewards those who think clearly and move patiently. Buffett's approach reminds us that clarity compounds just as powerfully as capital does. By focusing on understanding, discipline, and time, he turns simplicity into a lasting advantage. At Wealth Surge, this philosophy sits at the core of everything we explore. Not chasing every opportunity, not reacting to every headline, but learning to think long-term, filter relentlessly, and let patience do the heavy lifting. Patience beats noise. Clarity compounds.